Welcome back to Organized, the business law breakdown. I'm Professor Seth C. Oranburg, and today we're going to continue talking about organizational choices with one of the most important and most formal of the business entities, the corporation. Corporations dominate modern economic life. They're the default structure for large-scale operations and for public companies, but they're not just for the Fortune 500. Small businesses, startups, and nonprofits can also benefit from the stability and legal clarity that corporations provide. So let's walk through how corporations work using our handy-dandy 7-issue framework. To get started, what is a corporation again? A corporation is a legal person or a legal entity, an artifice created by the state or by state law. Corporations, like people, can own property, enter into contracts. They can sue. They can be sued. But most importantly, a corporation is a type of entity that separates ownership and control. Shareholders are the owners. They invest capital and expect returns. Directors and officers manage the business. They make strategic and day-to-day decisions. This separation allows corporations to scale by coordinating capital and labor across large groups of people and across long periods of time, which also offers powerful protections for investors through limited liability. So let's talk about our 7 factors, beginning with factor 1, formation. Unlike partnerships, a corporation can't arise by accident. To form a corporation, you must file the Articles of Incorporation, sometimes called a certificate of incorporation, with the Secretary of State for the state in which you want to incorporate. The filing must include the corporate name, the number of authorized shares, and the name and address of the incorporator. It also has to specify a registered agent to receive service of process. And if you're out of state, you can hire one who can act as your agent in state, because the corporation has to be able to be sued in the state in which it's incorporated. This filing will create the entity, and the Internal Affairs Doctrine tells us that the law of the state of incorporation governs the internal relationships. Even if the company operates in, say, Nevada, if it's incorporated in Delaware, Delaware General Corporation Law governs its internal affairs. So the choice of whether to form a corporation is just one aspect. We also want to know where to form the corporation, because corporate law differs state to state. Number 2 is liability. Shareholders in a corporation enjoy limited liability. They can lose their investment, but not their house, their car, or their savings if the business goes under. There are exceptions to this, and we'll talk about them later. Piercing the corporate veil allows courts to impose liability on shareholders when the corporation is used to commit fraud, or when it's grossly undercapitalized, or sometimes both. Directors and officers can be held liable for breaching fiduciary duties as well. They owe these duties to the corporation, and there's a complicated process called derivative litigation, or a derivative lawsuit, where the corporation can hold its directors and officers to account. But overall, the corporation offers strong legal insulation, especially compared to general partnerships, which have unlimited liability. Third is control rights. Corporations are hierarchical by design. The shareholders elect a board of directors, the board appoints officers, and the officers run day-to-day operations. The board only gets together when there's an extraordinary decision to be made, like hiring or firing a CEO or deciding on whether or not to have a major strategic partnership or initiative. The officers, by which I mean the chief executive officer, the CEO, and the C-suite, and then on down through the vice presidents and management and down to day-to-day people, run the day-to-day operations. Voting power of shareholders is usually proportional to share ownership. 1 share, 1 vote. But again, shareholders don't control the company. They really only vote for one thing, which is who the directors are, and then the directors control the company. This structure enables scalability, but it also creates agency problems, where managers' interests diverge from those of shareholders. One reason that I spent 2 whole seasons talking about agency law and then the economic analysis of agency law is corporate law is best understood as a solution to agency problems. So if you really want to understand corporate law, you really need to understand agency theory. But for now, let's continue with deciding whether a corporation is the right form for the type of business you want to create. And our fourth aspect is financial rights. Shareholders have limited financial rights. They have a right to dividends and to residuals. But this only happens if the board decides to issue dividends or to wind up the affairs of the company, for example, in a merger. So these rights to dividends often depend on what exactly the stock certificate provides or what the board decides to offer. And when shareholders get issued dividends, they have to pay taxes on these dividends. It creates a situation called corporate double taxation because the corporation itself also pays tax on its own income, whether or not it's issued as a dividend. Shareholders benefit from capital gains. Usually, shareholders invest in companies for a period of more than 1 year. And so their taxation on the dividends or on the sale of their shares is going to be based on a lower tax rate by virtue of having held the shares for more than a year. If you hold shares for less than a year and you sell them, you can get charged ordinary income tax on those shares. So shareholders have the right to dividends and to the liquidity value of their shares increasing in price over time. But unlike partnerships, corporations face double taxation because first the corporation pays taxes on its income and then shareholders pay tax dividends on what they've received. Some corporations, by the way, can elect what's called a subchapter S status to avoid this. But S corporations come with strict eligibility rules. And for many companies that want to have no corporate taxation, the limited liability company is going to be a better choice. We'll talk about that separately. Continuity of existence is our fifth category, and corporations, unlike limited partnerships, are built for perpetual existence. We previously discussed how limited partnerships are inherently temporary. They're investment vehicles where you'd expect a return when the project is complete. Corporations are built for perpetual existence, so they don't dissolve when shareholders sell their stock or when officers leave. They're completely separate entities, and they have the most firmly established status as person-like entities or artifices in the legal world. And this stability makes them ideal for long-term investments and complex operations, which is why you often see research and development occurring inside a corporation. Dissolution of a corporation occurs voluntarily through a shareholder vote or involuntarily through administrative or judicial action. But again, the purpose of a corporation is perpetual existence, and usually for any profitable purpose. So that makes them quite different from the limited partnership form. Moving to liquidity, which is how easy it is to transfer stock, of all of our forms, stock in a corporation is the most liquid. It can be the most freely bought and sold on markets. This is especially true with public corporations, which are named such because they have publicly traded shares, which have been registered with the SEC so that you can buy and sell them on stock exchanges. Private corporations, including venture-backed companies, startups, often have contractual transfer restrictions through shareholder agreements or bylaws, and securities regulation can prohibit certain transfers of stock to certain persons at certain times. But in general, on the liquidity point, stock in a corporation is the most liquid. It's the easiest to transfer, and it's also the most fungible in the sense it's very clear to understand what a share of common stock means. The set of rights, the bundle of rights that's inherent in having a share of stock is pretty consistent over different types of corporations, making them more liquid because we have a little bit more of a commodity here, something that people can understand more easily without having to read all the fine print, as compared with what does it mean to have a unit in an LLC will depend on the operating agreement. So liquidity is a major feature of a corporation, and liquidity helps corporations raise capital by allowing investors to enter and exit more easily. You'd be more likely to invest in a company if you can exit that investment easily as well. Finally, we talk about mergers. Corporate law has a well-developed framework for mergers and acquisitions, and it's really the subject of an entire course called Mergers and Acquisitions. Most states follow some version of the Model Business Corporations Act or a derivative of the Delaware General Corporation Law, and both of them are fairly consistent in having a standard way to operate a merger. Mergers require a plan of merger that's approved by the board and approved by the shareholders. Now, usually this is a majority of the shareholders, but we can have all different voting situations as well. And then there's a filing of a certificate of merger with the state. The process is formal, but it's familiar and it's efficient. And there's an entire industry known as M&A, mergers and acquisitions, built around specializing in this process. So it's very well understood and a very consistent way to get liquidity at the end of a company's life by merging with another company. Again, this is a very brief overview here, so there's a lot more to mergers, but that would take an entire course to cover. So let's summarize. Corporations offer limited liability, perpetual existence, centralized control, and strong access to capital markets. But they also bring formalities, regulatory burdens, double taxation, and potential for managerial abuse because of the agency costs inherent in the distinction between ownership and control. Still, for most large businesses and many startups, corporations remain the gold standard. So you might think about why a startup founder would prefer a corporation, even knowing there's double taxation. Why is a corporation worth the trade-offs? And by the way, double taxation, I'm only referring to the amount you pay to the IRS. In addition, you often pay taxation to the state in which you're incorporated. So having a corporation is kind of expensive, yet we see a lot of them. So what does that tell us? It tells us that they must be very valuable for organizing certain types of businesses. And that's worth thinking about when deciding what type of organization to form. Thanks for listening to this episode of Organized, the Business Law Breakdown. In our next episode, we'll explore limited liability companies, one of the most flexible and popular entity choices today. Until then, take care and remember, law doesn't just regulate business, it organizes it.